Hi, this is Professor Karen Lin. Welcome to the Financial Accounting for Undergraduate Students. In this video, we are going to discuss classified income statement. Let's get started. In the previous video, we talked about a couple of different transactions which you could read the book for the complete series of transactions, and we wrote the journal entries. Now the next step is to post the journal entries to the T accounts. These are a simplified version of the general ledgers, which would sort all the transactions by the accounts that associated with the transaction and also tell us the net effects of the transactions to our financial system. For example, after the journal entries posted to the cash account, we could find out the ending balance of cash account is $500, which means if you now go to the company and count the cash, you should be able to find $500 in the company. Now, when we talk about cash, one more note is that in accounting, cash is not really referred to cash that we count in our wallet or something. The cash assets in the bank are also considered cash. So when I say count cash, I mean you would find $500 either in the form of cash or in the bank. When we posted the journal entries to the T accounts, we also see these are the income statement accounts, revenues and expenses. Now in chapter 4, we are going to talk about how these accounts will be closed. Okay, all the income statement accounts will be closed to the balance sheet account named retained earnings, which is basically the connection between the balance sheet equation and the income statement equation that we have talked about in our previous video. And remember, in chapter 2, we talked about after we posted everything to the T accounts, we are going to put them into something called the trial balance, where we can show the debit sides added up equals to the credit sides added up. If the summary of your debit sides are not the same as your credit sides, then you have a problem in recording or in posting. So the trial balance is really a tool to detect any errors, and you will notice that it says unadjusted trial balance. So when you see this term unadjusted, don't freak out. We will talk about adjustment in chapter 4, but right now you only need to know these are the balances that from the T account that we just generated in our previous slides. Now here is the classified income statement of Chipotle for the period, which is a quarter, ended March 31st, 2020. When you look at this classified income statement, your first question might be, why is it called classified income statement, right? Classified means the accounts are categorized or classified in different categories. We are going to talk about each categories in the next few slides. Also pay attention because these are unadjusted accounts. We will talk about adjustment in the next chapter. So these accounts or the balances of these accounts are not released to external users. It's only for the internal users. Here is the completed income statement or the adjusted income statement that are reported to the outsiders. Income statement always starts with a line called revenue or sales, depending on the nature of the company. If it's, for example, if it's a company providing guitar lessons, it would start with service revenue. If it's a merchandising company, it would start it with sales or sales revenue. And you will see all the expenses are classified into different categories. The first section of this income statement is called the operating section, which is the central focus of the business. So these are accounts that are affected by the central operation or central business of the company. The second category is other items. Other items are not central focus of our business. For example, if we earn interest revenue or if we pay interest expense, those are not from selling beverages or foods by Chipotle. So they are not Chipotle's day-to-day operation. Let's formally define operating revenues. Operating revenues are the amounts earned and recorded from a company's day-to-day business activities. For example, for Chipotle, when Chipotle sold burritos or soda, those are operating revenue, and when they sell it, those are considered earned revenue. Operating expenses, on the other hand, are the resources spent to generate the operating revenue. So formally, operating expenses are the costs of operating the business that are incurred to generate revenues during the period. Now remember, periodical assumption. Incurred means the resources or services of others that are used. All right, other income statement items. Not all the activities on the income statement are central to our business. So other income statement items is a category contains the items that affects the company but not to their day-to-day business. So these includes interest revenue, interest expense, losses on sales of investments. Now you have to memorize these. You have to memorize the other items. For now, it's pretty simple. It's the interest, revenue or expenses, and gains or losses on the sale of investments. So when you review this income statement again, you will find that this income statement has a relationship. We start with the sales revenue, and then we classify the expenses into operating expenses, general and administrative expenses, and then loss on disposal of assets, right? What are operating expenses? These are expenses that related to the day-to-day sales of food for Chipotle. The general and administrative expenses are the expenses that related to the management of the company. For example, if there is a manager sitting in the office who does not sell the products to the clients, the training of that manager is expenses would be under the general and administrative. If you have advertising, that would be also under the general and administrative. In some companies, this account is called sales, general and administrative. Sales, general and administrative. So also shorted to be SG&A. Here comes a little bit more subtle question. So if I ask you, for example, Chipotle hire an accountant or a secretary working for the manager, the wage of the secretary, would that be under restaurant operating expenses or under SG&A? The answer is, if you hire a secretary, that's for the manager, and for managing administrative activities, the secretary's wage expenses should be classified under SG&A. Or versus if you have a staff, right, selling foods or serving at the tables, those wage expenses you will see here are listed under restaurant operating expenses. So it really depends. Even you have paying the same wage, it really depends the function of that personnel. All right, so revenue minus all these operating expenses equals to income from operations. So revenue minus all the expenses added up, total operating expenses. So 55886 subtracting 5142 equals to 444. You will see there is a single line underneath this loss on disposal. It means that we are adding everything above up. The number underneath the single line is the subtotal. And this 444 is sort of under a thicker line, which means this is grand total for this operating section. 444 equals to the revenue minus the total operating expenses. Now, income from operation will be changed with other items including interest revenue and interest expense. Income from operation adding interest revenue subtracting interest expense equals to income before tax. Okay, income before income taxes. So 458 is equal to 444 plus 17 minus 3. Now this number is the basis for IRS to calculate income taxes for the company. Using appropriate tax rate, which we are not going to cover in this course, the income tax expense will be 108. Now you would ask, why is income tax an expense, right? It is, remember what is the idea of expense? It is resources incurred to generate revenue, matching principle. Because the company uses government services during the quarter or the year, it has to pay taxes to the government. So when it pays taxes to the government, the tax would be considered an expense, because without the government services, the business cannot be smoothly running. So that's why in accounting it's called an expense. Income before taxes subtracting tax would be the net income. Now this net income is the final result of the firm's performance. Usually underneath the income statement, companies report something called earnings per share, EPS, earnings per share. Earnings per share is just the net income divided by the number of shares outstanding in the market. So we're going to talk about shares outstanding in chapter 11. But you just need to understand the idea is that EPS, earnings per share, is an indicator of how profitable the firm is for each share that the shareholders holds. So EPS $12.62 means for each share that a shareholder holds, the earning for that particular share is $12.62. EPS helps companies to compare across different companies. For example, both Chipotle and a small company earn $3.50. They earn the same money, but Chipotle has 3,000 shares outstanding versus the small company has only 2 shareholders, right? If that's the case, when you calculate Chipotle's EPS, it's $12.62. But for that small company, everybody only two shares, say owned by 2 different shareholders. Each shareholder for that particular share earns $175. It's much higher than 12.62. So if you only compare net income, these 2 companies are the same, are 350 and 350, but because they have different number of shares, each share's profitability is actually different. So EPS helps us to compare firms with different sizes in terms of the number of shares outstanding. All right, so this concludes the chapter of the income statement, and I'll see you in the next video.